Continuing on with our example, George, then, in the last session we posted and balanced all the accounts. So we posted the transactions to the main ledger, and then in that very last session that we just did, we balanced off those ledger accounts. Now what we need to do is use those balances and bring them into our trial balance. Now a trial balance is a list of brought forward balances from your ledger accounts. So let's write that down. The trial balance is a list of brought forward balances. Okay, and those brought forward balances come from our ledger accounts. So you should still have your ledger accounts handy, and you've now balanced them all up from our last recording. Now we're going to have a look at this trial balance. Now this trial balance is still an internal document. This is still something that we do not publish to our external users. The main reason why we do this trial balance is to really look and detect errors and spot those errors if we can see any in our ledger accounts. So really, this is the final check before we then post to our financial statements. This is really very straightforward. What we have in the trial balance is we have the account name that has come from each of our main ledger accounts. We've got the financial statement that that account relates to, so the statement of financial position or the statement of comprehensive income. And then we have two columns to show the figures. One column, which is the debit column, DR, and the second column being the credit column, CR. And these are going to list all those brought forward balances, those amounts, and we're going to extract them from the ledger accounts. So you can see in your notes then we have all the account names that we've opened up already sat on our trial balance. What we need to do is bring in the figures from our main ledger. Let's take a look at our first main ledger account. We said that was cash at bank. And notice that we had a brought forward balance brought down on the debit side of the cash at bank account of $43,550. Debit side, we've got the amount. We also know that that's being posted to our statement of financial position, one of our financial statements. Okay, let's start to complete our trial balance. So for the cash at bank or bank account, the financial statement is the SFP, the statement of financial position, and the amount was $43,550, and we're going to list that on the debit column. Okay, so underneath the debit column. And that's pretty much it with the trial balance. Now we need to do the remaining accounts and post them as well. So going back to our main ledger, our next account was the capital account. And the capital account was $50,000 balance brought forward on the credit side. And again, we already know that that's an SFP account. So let's proceed. In our trial balance, next to capital, the account name, it goes into the statement of financial position, SFP, and that's going on the credit side of $50,000. Okay, and we'll proceed and continue on. Our next account was purchases. So if we pull that up, our purchases account, we can see that it was $12,000 balance brought forward on the debit side, and that is coming and going into, should I say, our statement of comprehensive income. It's an expense, remember. So let's do that. Purchases, financial statement is the SOCI, statement of comprehensive income, and we said that that was a $12,000 debit transaction. Next one then, is our trade payables, or payables as we called it. Going back to our main ledger, payables, we can see that we have a $7,000 credit balance brought forward in the ledger, and that is in our statement of financial position. That's where it will ultimately end up. So trade payables, an SFP figure, $7,000 on the credit side. Going back to our main ledger, our next account is sales. Sales, we had a balance brought forward of $12,000 on the credit side, and that is ultimately going to be posted to our statement of comprehensive income. So in our trial balance, statement of comprehensive income, $12,000 credit. And again, hopefully when you're at home and you're seeing this, you will appreciate that you might be going a little bit faster than this now, because hopefully you've pretty much got the idea of what we're doing here. Okay, so main ledger, let's go for rent this time. Our next account, $450 balance brought forward on the debit side this time. And again, it's a statement of comprehensive income item. So, financial statement, SOCI, $450 in the debit column this time. Okay, next account then, trade receivables. Trade receivables, $6,000 balance brought forward on the debit side, and that is a statement of financial position item. Remember, it's an asset. In our trial balance, trade receivables goes to our SFP, $6,000 would go into the debit column. Finally then, we have motor vehicles, going to our main ledger. Motor vehicles, $7,000 debit, and again, that's an SFP item. Posting that to our trial balance, financial statement SFP, $7,000 debit. And there you have it. Every account, the balance brought forward, list it in your trial balance. Now you should be able to balance this trial balance and have both the debit and the credit column be equal. If that's the case, that's a pretty good indicator that you've done everything correctly. So let's just double check that then. Our debit column, we start with $43,550 plus $12,000 plus $450 plus $6,000 plus $7,000. Well, that should give us $69,000, the total of the debit column. Let's check the credit column. $50,000 plus $7,000 plus $12,000. Look at that. The total of the credit column equals $69,000. And you notice I have a little smile because if your trial balance balances, you pretty much know you've done everything just about correct. Now, the trial balance is probably one of the best indicators to check for errors, to see if there's anything wrong. Because if those two columns don't balance, well, you've done something wrong in your ledger accounts. We'll have a session later on in the course where we look at errors and using the trial balance to detect errors. But for now, it balances, so we won't worry about it. Everything must be okay. Now, this isn't the final thing that we need to do before our financial statements. At this point, we need to do one final journal. And this final journal is all to do with inventory. Now, we're going to deal with now the idea of closing inventory or ending inventory. Closing inventory is all the stock left in the business at the end of the accounting period that hasn't yet been sold to external customers. Now, remember how we said in the statement of financial position, inventory is a current asset. Remember we said that a few sessions ago. What we need to do is be able to value that asset and show how much inventory is left in the business that we can sell in the next accounting period and generate cash from. Remember, inventory is what we own. Now, when we've dealt with inventory transactions, we've either posted them to purchases if we've bought them, or sales if we sold them. This is focusing on the idea of the asset at the end of the period. So, first thing we need to do is find the valuation of our inventory that's left over at the end of the accounting period. At this point, it might be helpful for you to pull up the original question, George, and look at those 8 transactions once more. and look at what transactions involve inventory. Okay, so have a quick look at that. Maybe pause your recording whilst you're having a brief look at all the transactions that involved inventory. Okay, so essentially there's 4 transactions in this question of George that involve inventory or goods. The first transaction was on the 2nd of April 2009, where George purchased goods on credit. And he purchased those goods for $5,000. He brought that inventory into the business. We're putting it in at the cost, or its original cost, to the business. That would increase the inventory value. We want the inventory value at the end of the period, so the 14th of April. So our next transaction that involved inventory, well, that was the transaction immediately after, on the 3rd of April. And that transaction involved a sale of half of those goods, or half of that inventory. Now, if you're putting inventory in at its original cost, then you need to remove it out at its original cost. Okay? So you're not removing $6,000 out, which is the value of the sale. All we're saying there is that, well, if we've sold it for $6,000, we must have made a profit because we only bought it in for $5,000. So if you're putting it in at its original cost, you need to take it out because the difference between the cost and what you sold it for, well, obviously that's the profit. So what we're going to do is remove inventory, half of that inventory in this transaction, so half of the original cost, which would obviously be $2,500. I'm putting it in brackets to take it away. At that point then, George only has half of his stock left at an original cost of $2,500. Hopefully you've noticed then that the next transaction after that was again another sale. And that was the sale of his remaining inventory on the 6th of April. And that would be the other half of the inventory because it says the remaining amount. So if that's the case, then that must be the other half of the inventory with the remaining cost of $2,500. At this point, there's no inventory left. All the inventory that's been purchased has indeed now been sold up to the 6th of April. But remember then, we had one more transaction, and you should be able to see on the 7th of April, he purchased more goods on credit for $7,000. He's brought $7,000 worth of inventory into his business. Okay, $7,000. So that's going to increase our inventory balance back up. So at that point then, we have that inventory in stock. The final transaction on the 8th of April was all to do with a delivery van, which is not inventory. So that must be it. The 14th of April, our year end, our closing inventory balance must be the $7,000 worth of goods remaining at the year end. Now we are going to look at inventory in a bit more detail in later sessions, and actually it'll be one of our next sessions in chapter 4. In the meantime though, we have our inventory valuation. Everything that goes in at cost has got to come out at cost. Now, the final thing that we need to do then is say, well, where does inventory fit in the financial statements? Well, as I've already mentioned, inventory is an asset. It's a current asset. That asset is available for sale in the next accounting period. But there has to be a double entry. Remember, this is a journal where the double entry gets posted. So, the physical journal itself. Well, we have an asset of inventory. So we're going to increase inventory asset. Remember, an asset appears on the statement of financial position with that $7,000 valuation. Now, increase in an asset, a debit or a credit entry. Hopefully you're all saying debit, based on what we learnt in previous sessions. It is indeed a debit entry. And obviously, we're going to have a corresponding credit entry. Now, as I explained when we looked at the statement of comprehensive income in detail in earlier sessions, we need to see closing inventory not only as an asset, but also as a reduction in our cost of sales in our statement of comprehensive income. Let's write that down. Okay. So what we're going to do is decrease cost of sales. And cost of sales is essentially all your expenses or costs to make what you sold. And to reduce cost of sales in the statement of comprehensive income, so just write there, SOCI, we're going to do that with the inventory valuation of $7,000. Sometimes you see this referred to as a credit to closing inventory in the statement of comprehensive income, but it means the same thing. To reduce an expense or a group of expenses, as we'll see with cost of sales, that is going to be a credit entry. Remember, increasing expense is a debit, the E and D click, we're going to reduce it down. Now, the reason why we're showing it here is because when we have purchases in the statement of comprehensive income, purchases is going to be for the full amount of inventory that we purchased in the period. If you remember from our trial balance, our purchases expense was $12,000. But we didn't sell all the goods that we purchased in the year. Now, we have to think about this principle of matching or accruals, again, as we saw earlier on. We must match everything that we earn to everything that we incur. We must match our sales income to the cost of generating that income. Well, the cost is going to be based on only the goods that have been sold. And we can see in this list that we've only sold $5,000 worth of goods at its original cost. So in order to get a true profit for that accounting period, we need to remove that $7,000 closing inventory from cost of sales, which is where purchases will appear as well, in order to be able to show a true gross profit in the statement of comprehensive income. So it's all about matching, which we discussed, like I say, earlier on. We have got a dedicated session devoted to inventory. We'll leave it there for now, and we'll proceed to prepare the financial statements, and we'll see how this journal works in action in our next session. Our next session, we will then prepare the statement of comprehensive income for George.